Good morning, I'm Cynthia for Wall Street Media, and I'm here with Doug, and we'll help you make money in the stock market with information you will not find anywhere else.
Hey, gorgeous, how you doing?
I'm
Popped
very
in
good.
from the West Coast, right?
Well, it was London, Atlanta, and Texas.
So not exactly the West Coast, but I was close.
You were pretty close, but you know, I had a good time.
Yeah,
My flights were really nice.
That's all that matters.
Yeah.
I'm flying out tomorrow.
I know you are, Vietnam.
I'm a Vietnam boy.
Are you going to come back?
I don't know. You know what I'm going to do? I'm going to do like the Apocalypse Now thing and send a note back and just say, sell the house, sell the car, sell the kids. I'm never coming home.
No,
I'm sending it to German Mike.
I was worried more about where you're going.
To Vietnam?
Will you make it back?
I don't know. I guess I will.
I was thinking about that today. I was like, I should go with Doug, and then I thought,
you should.
I'll probably not make it back, so I'll just leave Doug by himself.
Oh, you wouldn't come with me. We'll wear camos.
With my hair and my skin, I'm done.
It wouldn't be good?
Done. No.
All right.
Okay, so we got some stuff from Rich Gordon today. Fixed income market strategist of Wachovia, WB, discusses the shift by the Treasury Department and the focus of the TARP Plan, which will now extend from credit to credit card, auto, and student loans, as opposed to the original plan to purchase distressed mortgage-related assets.
It's ridiculous, right? Now, I don't know if you saw the latest news, right? You were flying. You flew in last night, right?
Flew in last night.
Bank of America is taking $7 billion of the TARP money, and the way they're going to help out the mortgage crisis is they're investing it in the shares of a Chinese bank.
Is that a good thing or a bad thing?
I don't know, but I don't think it's going to help mortgages a whole hell of a lot.
Yeah, I read that actually. I read that.
You're on top of everything,
Yeah,
but because you're on the flight, I didn't know if you had caught that or not.
I get the newspaper. See, because
on the Kindle.
Well, I can only read my Kindle when you can use electronic devices. So what I do is I get the New York Times, and then I get the the Wall Street Journal. I either get the New York Times or Wall Street Journal, usually Wall Street Journal, and then I get my National Geographic. I'm in love with National Geographic.
Yeah.
Do you know? I think I saw a little special where I could get a whole subscription for 12 months for only $15.
You should get it.
I know. I just don't like mail.
Here's my funniest electronic story? German Mike is flying back to Germany one of the times, right? And he sends me email and says, "Oh, this is bullshit," right? He says, "The plane's not going to crash." He was up in the air and turned on his PDA just to see if it would work or not, if it would mess up with the plane.
Those things aren't true. The other day I was on the plane.
He did it, though. He was outraged that they told him it would make the plane crash, and he tried it, and it didn't.
It doesn't. And also, we were on a plane, when I was on the plane coming from Texas back to New York, they said that somebody still has their electronic device on if they could turn it off. I swear they're lying. I swear they're lying.
Yeah,
it's like a test.
Yeah,
they said, we just got a message from the flight crew that they have some interference. If you could please turn off your cell phones.
Yeah, that's no good. German Mike says perhaps we should talk about Wachovia and the TARP Plan. Didn't you hear the Chinese bank part, German Mike? All right. Anyhow, here's Rich Gordon. We love him. He's fantastic. Let's take a look at his video.
Go to the clip.
The biggest news last week was a dramatic shift by the Treasury Department in the focus of the TARP Plan. It was originally intended to purchase distressed mortgage-related assets from bank balance sheets. Several weeks ago, the Treasury Department announced that a portion of the TARP funds would be used for direct capital injections into banks. Last week, they decided that instead of buying distressed assets, they were going to directly extend credit for credit card, auto, and student loans. The shift makes sense because the contraction in U.S. economic activity deepened in October, and the cost of loans for even the best consumer credits has increased dramatically. This spike in the cost of consumer credit, coupled with the tightening in bank lending standards for consumer loans, resulted in a sharp decrease in retail sales in October. The stock market responded poorly to this strategic shift in the focus of the TARP, and stocks traded lower towards the end of last week and on Monday. While the trend on stock prices is still lower, the momentum of the trade-off has slowed considerably, and the general trend recently has been more sideways than down. However, on Monday, the S&P finished close to the low that was reached on October 27th, and with the economic data over the next few months very likely to be consistently grim, we think that stocks will set new lows in the coming weeks. While a massive response by the government to the credit crisis was both inevitable and necessary, investors have been lukewarm on it so far. The most disappointing outcome has been that even though the total amount of the U.S. government's liquidity support is going to end up being well over $1 trillion by the time it's all said and done, the measures really haven't spurred an increase in risk-taking activity, and fear continues to be the dominant emotion for investors. I think there are several reasons for continued concerns and why this workout process is going to last throughout 2009 and maybe even beyond that. First, the government's huge financial commitment will be honed over time as economic and financial conditions evolve. After all, it's better to be approximately right than absolutely wrong. But it has also become pretty clear that they really don't have a silver bullet solution to this crisis, no prior blueprint for success, and the shifts in focus for the TARP program illustrate the hindsight nature of this workout process. This realization has rattled investors and diminished their appetite for almost any risk right now. Second, investors have only gravitated towards areas where the government is giving direct support, but are avoiding sectors that haven't gotten support. The result has been a sharp tiering in the price of credit between the haves and the have-nots. This has been most observable in the financial sector, where debt spreads on banks have sharply contracted since the announcement of direct capital injections into those institutions. In the money market and CP space, we've seen substantial improvements in both tone and liquidity since the government set up the CPFF to purchase commercial paper. But that improvement has only benefited A1, P1 rated companies. The A2, P2 companies have had continued deterioration in their funding costs. Third, the loan modification programs for both GSE-eligible and non-GSE-eligible mortgage loans add another layer of uncertainty to the securitized product sectors. It makes it more difficult to forecast prepayment rates, default rates, and cash flows in complex structured products where cash flows get redirected when certain credit performance thresholds are breached. The logical response of investors to this type of uncertainty in this environment is to price to the most distressed assumptions. So while the government's modification programs benefit the current homeowners, future homeowners are hurt by having to essentially fund the loan modifications through higher mortgage rates. Turning to the spread markets, the investment-grade corporate sector has seen some signs of life. It tightened by 12 basis points last week, the second week in a row that spreads have tightened. Equally important, there's been some new issuance, and new issue concessions are significantly lower than the 150 to 200 basis point discounts that we saw during October. The credit curve continued to steepen between investment grade and high yield, as that sector has remained under constant pressure due to the abysmal recent economic reports and increase in the speculative grade corporate default rate. The fixed income residential real estate sector was clearly hurt by the government's decision to change course and use the TARP for direct lending to consumers rather than to purchase distressed mortgage assets. The price of AAA ABX fell by almost 15% last week, as it continues to follow the lower-rated tranches towards terminal value. A lot of the government's efforts to decrease foreclosure filings have been focused on individual mortgagors in the residential market. It'll be interesting to see when and how they deal with the problems in the commercial mortgage space. AAA CMBS prices are now trading in the low 70s, and that sector has seen a rapid repricing since the beginning of October. The reasons for the sharp decline have mostly been systemic and liquidity-driven. Unwinds by leveraged investors, much larger haircuts from dealers on financing, lack of capital in financials, and sales of product from bank portfolios. But if the economy continues on its current path, then actual losses will begin to eat through the protections of the capital structure and bring rating agency downgrades, more selling, and new rounds of sharp price declines. Right now, investors are assuming the worst-case outcomes for this sector, so further price declines become a self-fulfilling prophecy. And who can blame them? If losses extend up through the A-rated or even AA-rated part of the capital structure, then those concerns appear to be reasonable, and CMBS prices will probably continue on the path that subprime prices took. From a macro standpoint, it means that there's very little commercial mortgage lending happening now and for the foreseeable future, which will create substantial headwinds for any eventual recovery momentum.
I love Rich Gordon. He's fantastic, right?
It's very good. That TARP plan.
Oh, yeah. You know what's going to happen next? Did you see?
TARPs are for covering things, aren't they?
Yes, they are. I love you
I was just going to say, let's see, is there a play on words here? Because you know, they make up these words very cleverly.
Did you see the GM guys took his $36 million
But
jet?
TARPs are also meant to protect.
Did you see down there the GM guy took his $36 million plane to Congress by himself so that he could go and plead for the bailout funds?
I did. I saw that, but I like the picture that was on the cover of the newspaper where it had like a missing seat. Like everybody was there, but there was one guy missing from GM, so they had his seat missing.
Yeah, it's amazing,
and they showed like an empty
right?
seat. He probably went to the bathroom, you know.
Yeah, it's amazing.
And they're like, "Look, he's missing."
Yeah.
Don't you love context and like how they just take things
It's
out?
completely
you know?
out, yeah.
Yeah, yeah. Guys,
Oh.
he didn't show up.
Horrible, right? Well, thanks for that. And guys, hope Rich Gordon, we love, super smart guy. I hope you enjoyed that. We'll have him again, probably not next week because of Thanksgiving, but the week after.
So, have a good day. We'll see you again soon. Say goodbye, Doug. And don't forget, WSMCEO.com is where you can find us directly. Also, don't forget to try out Covester.
Stock twist.
I was about to get there. Stock Twits, and we also have
Investopedia. Which we love, right?
And they're all free. So go ahead, check those out, and we'll see you again soon. Say goodbye, Doug.
Goodbye.